Hi everybody, well, guess where we are? Yep, we're in London. We've arrived at Old Billingsgate, and in about 10 minutes I'm going to be giving my presentation on how to immunise yourself against SDLT overpayments. If you couldn't make it down today, it's a shame. If you're interested in finding out whether you've overpaid SDLT, or indeed whether we can save you it on your next purchase, click on the link below, click like and subscribe to hear more from us, and we'll talk to you soon. My name's David Hannah of Cornerstone Tax, and this is a bit of a quick walk through SDLT, some of the issues, about the complexities of it, why SDLT payments often occur, and some of the 49 reliefs that you as investors, dealers and developers can acquaint yourself with. So let's just remind ourselves, well, A, who I am. Has anybody in this room not heard me speak before? Oh, good. So we're a firm of chartered tax advisors, and we specialise in property tax matters, specifically SDLT, but the other attendant taxes. We provide a comprehensive service, certification, relief claims management, right the way through to management of HMRC enquiries should one arise. We can do pre-transaction advisory, we can do post-transaction review and recovery of overpaid SDLT. We have our PI, naturally, as a professional firm. But let's talk about SDLT. 18 years old this year, introduced in 2003, replaced the old stamp duty. The old stamp duty, for those of you who are over the age of 35, was a duty on documents. The new stamp duty land tax, which rather unhelpfully didn't replace the name completely, is actually a self-assessment tax. And as a result, it's complex. It's been changed more often at its fundamentals in the last 18 years than any other tax I can think of. It does apply to all acquisitions of residential and non-residential land and property interests in the United Kingdom. And I can't emphasise this enough. The old stamp duty was about transfer of title. In this tax, you can have a charge to tax when title doesn't move. You can similarly not have a charge to tax when title does. It's got irrelevant to your TR1, whatever your solicitor says. And this is the problem. Because of that complexity, which now depends on a number of factors, the type of property you're buying, who you are as a purchaser, the nature of the transaction, whether it's connected or not, the number of dwellings you or your company already own, and the way you pay for it, all have a material bearing on the rate of tax and the total amount of tax you can pay. You can often end up with multiple rates for the same property. If you're a corporate purchaser, for example, you could end up with a rate of 12 or 15%. If you're a non-resident company, 12 plus 3 plus 2, 17%. But if it's not residential, it could be 5%. And if you've got multiple dwellings relief, it could go as low as 3 or even 1%. All these different permutations would normally be factored into any single transaction you do. They have to be considered. And the problem is, we all do it. We go in, we want to buy a property, we talk to our solicitor, we say, what's your quote for conveyancing? And what's the first thing we all do? We all suck in our teeth and go, that's a bit high, can you get it down a bit? What we do by cutting that fee is we don't give that solicitor the chance and the time, because we all pay for their time to really consider the tax position. We kind of connive at our own destruction a little bit. But similarly, property conveyancers are not tax experts. They generally went into property because they really didn't want the excitement and rapid change that happens in the tax world. So don't expect them to be tax experts, and don't expect them to accurately calculate the first figure they give you for your stamp duty, or indeed the last one in many cases. So, quick review of the rates. If I stand this way, so the speaker can't get me for feedback. As we all know, we had the SDLT holiday, then it was pared down, and here's where we are now. But more interestingly, we have the, of course, additional rate for second homes, which has been with us since 2016. But since the 1st of April this year, we've had the 2% rate for non-residents. And I'm going to go into that in a little bit of detail today, because it's going to create even more problems in certain circumstances. So we've seen a series of issues down the years, and I'm sorry for these, this is just a digest of headlines, but I think this is the interesting one. Stamp duty refunds went up 285% during lockdown. Why would that be? The answer was, we're all sitting at home, we can't do deals. There was a chance to look back and review what we'd done. And people were finding more and more that they'd overpaid. Multiple dwellings relief had been missed. Properties had been misclassified. To a tax specialist like me, perfectly obvious relief claims had been omitted. All of these things contribute to that rise in overpayments. We have a higher compliance standard for tax in the conveyancing industry, but I don't know of a single firm that's actually meeting it at the moment. They don't know how. I talk to conveyancing firms all the time and I say, what are you doing to meet the audit trail requirements over your stamp duty calculation, which has been enforced now for 2 years, and they go, oh, our people are still looking at it. Because they genuinely don't do tax work. Not all houses are residential, and I'll come to that one in a minute, because the Bewley case, although it's mature, is still ongoing. We estimate that the overpayments of SDLT may be as much as £2 billion a year. That's a BN, £2 billion a year. When you measure that against over at about 1.5 million transactions, you can see that the numbers involved are quite chunky and potentially quite high. So what about this new 2% surcharge? How can it hit you and your companies? Well, the first good news is it only applies to residential property. If you've got a mixed-use property, not 100% residential, block of 3 flats over a shop, you don't have to worry about 2% surcharge. It applies to all non-resident persons, however. Now, I'm going to risk insulting some people in this room. When it was first mooted, it was mooted as being preventing foreign buyers from coming in and denying properties to domestic purchasers and particularly owner-occupiers. But when we got the tax, we actually found that it applied to non-resident persons. It applies to individuals, to partnerships, to trusts, to companies, including UK companies. But surely UK companies are UK resident. Not according to this law, under certain circumstances, and this is one of the traps. But some companies are excluded, naturally, particularly those owned by the government. So how does it work? You are non-resident as an individual if you are present in the UK for less than 183 days in the 365 days leading up to completion. Do you feel confused? If you're going to be buying a large amount of residential property, resist the temptation to take that 7-month holiday in Thailand. I actually have a colleague who has been locked down in New Zealand since February last year. If she returned to the UK today as a UK passport holder and bought a house, she'd be required to pay 2%. That doesn't sound to me like where the policy was intended, but that's where it's landing. If you're joint purchasers, you're both deemed to have been in the UK if one of you has been here more than 6 months. So if you really don't like your spouse, send them here for 6 months so you don't have to pay 2% surcharge. It gets better. Or if either of you work for the Crown under a contract of employment, then you're relieved. You don't have to worry about it. Job's a good one. We're government. We'll opt ourselves out of it. And then finally, if you're buying the property for your own use, we're talking owner occupation, main residence, sorry, then you can recover it once the 183-day test is satisfied in the 730 days bridging the date of completion, or the year before and the year after. But it only exists where you're buying on your own behalf. If you're not buying on your own behalf, you don't get the right to reclaim it. So if you've toddled along, you're in a family partnership, and one member of that partnership has been overseas for more than 183 days in the preceding 12 months, then the partnership will pay 2% surcharge. And it will also apply to trustees of discretionary trusts, but to beneficiaries of life interest trusts. Sorry to go into so much detail, but we often hold properties on trust, and they're still popular. Companies, however, fairly straightforward. Non-UK companies, they're not registered in the UK, therefore they can't have been here. Not a problem. And a UK company, if it is close, has 5 or fewer participators, and that covers a lot of family companies, and any of the participators fail the 183-day test. And we'll come to a detailed example in a minute. But that doesn't apply if you're a building society, a registered society, a company controlled by the Crown, an OIC, a REIT, a COAX, but only if they're UK incorporated and managed. I don't know, anybody in the room own a REIT or a COAX? No, okay, fine. And finally, you're a financial institution involved in Sharia finance. None of those have to satisfy the 183-day test in their own right. But if you're a Sharia lender, it's your borrower who has to satisfy the 183-day test. Yeah, you're shaking your head, sir. I had to go and lie down for 2 days with a cold flannel over my head after I read this legislation. It was like, I do not believe this. So let's have a look at an example. Typical family company, A Limited. That was an imaginative name. It's an incorporated company buying a UK dwelling. All of the shares in A Limited are owned by Julie and her 4 adult children. So we've got 5 20% shareholders. Julie and 3 of the children live in the UK. The other child is at university in Australia and hasn't been in the UK for more than a year. Well, hang on a minute. 80% of the shareholders are resident in the UK. We ought to be okay. I think you'd agree with me. But it is close. It's under the control of 5 or fewer. And although the company is incorporated in the UK, it's not resident if it meets the non-UK control test. And the way the non-UK control test is, and this is particularly unfair, if any of the shareholders is non-resident and is connected to any of the other shareholders who are UK resident, then the shareholdings of those UK resident shareholders are deemed to be owned by the non-resident one. These are all family members. This company is now 100% foreign owned and it pays 2% surcharge. So you've got to be very careful to make sure that those non-resident children don't have any shares in your company, aren't partners in your partnership. It's easy to suspend a partner from a partnership, more difficult to move shares around. So if you're building a structure that involves long-term family ownership, start thinking in terms of not letting the kids have the shares until they've settled down and settled somewhere. And if they settle anywhere other than the UK, don't give them any shares. Tell them tough. Otherwise, all purchases by that company going forward could be liable to 2%. That was the bad news. What can we talk about? What can developers, investors, private clients, dealers do? Tax reliefs. The biggest headline number at the moment is multiple dwellings relief. I must do 3 or more MDR calculations a week for clients. Everybody's doing buying portfolio properties, often with shops. Often I'm seeing the multiple dwellings has been got wrong. I'm seeing group companies moving assets around and being told they've got to pay SDLT even though they're in a group. There's such a thing as group relief. In total, there are 49 reliefs for SDLT. I shouldn't have given that number away. I should have done my pop quiz as I usually do, shouldn't I? When I normally do this and I lecture to solicitors, we often say, right, hands up who think that there are 5 or fewer reliefs for SDLT, and you get about a third of the room puts their hand up. Hands up who thinks there's 10 or fewer, half the room. Hand up who thinks there's 20 or fewer, the whole room. And then you hit the room and go, there are 49 reliefs for stamp duty land tax, many of which will give you a 100% exemption. The shock and horror in the room. These are the people doing that conveyancing. There are several specific reliefs for property traders, people who buy and sell quickly, probate purchases, stepping in to restore a broken chain, relocation of employment, taking in a property that would have been a part exchange from somebody buying a new property from a house builder. Sorry, it's quite a long one, that. All of those are 100% exempt. You pay no SDLT. But lawyers don't know about them. I had a conversation with a lawyer last year who said, wow, that's amazing. And we'd spotted it on one of his client purchases. This is amazing. He said, when did they introduce that? I said, 2003. The colour drained from his face. And I went, "You've done a few of those over the last 17 years. He went, "No comment," and ended the Teams call. But it was interesting. Residential or not, I mean, again, you know, we go back to the rates. This is key. If your property is not suitable for use as a dwelling, not habitable, or not wholly residential, you don't pay the 12%, you don't pay the 3%, and you don't pay the 2%. You only pay 5%. Now, I say that's a 12% difference. I wouldn't actually. It's actually a 240% difference in the tax payment. So when you express it in those terms, it gets to be a frightening number. A £1 million property, having it not wholly residential or not suitable for use as a dwelling, could save you £120,000. That's frightening. What can you do about all of these things? Well, the answer is do a health check. Ideally, do your health check before you buy. Do pre-deal evaluation of the site, pre-advice, the same way as you would do a pre-planning consultation. If I buy this, what stamp duty am I going to pay? Get it done as accurately as you can, because actually that helps you to improve your bid. If you know you're only going to pay, for example, 5% as against the next bidder who thinks he's going to pay 15%, your street's ahead because you can afford to up your bid slightly. When you get towards completion, tell your solicitor, I'm taking detailed tax advice. I don't want you to do the return. I can get it done myself. It's a self-assessment tax, people. You can do the return. It's your legal responsibility anyway. I know he sticks it under your nose and goes, "Sign there and give me a cheque." But that's your responsibility. You should take ownership of it because you might be able to benefit from it. And lastly, if you've gone through all that process anyway, you have up to 12 months in most cases, but up to 4 years in others, to go back and amend that return and reclaim the tax. And it's jolly good fun. So let's just talk about the habitable or not issue. If you're not habitable, you get down to 5%. If it's not suitable for use as a dwelling, Bewley is the case on this. If you're really interested in tax cases or you fancy a cure for insomnia, I recommend you go and read it. What was interesting about that case was the comments of the judge when HMRC, in their judgment, they actually said at one stage, at one point we found ourselves wondering exactly what HMRC's argument was. Indeed, at one stage we wondered whether they in fact had one. HMRC catastrophically lost that case, by the way. And the Bewleys ended up with a refund. Think about the minimum standards for habitation. Bathroom, kitchen, toilets are an absolute minimum, aren't they? You can't put a tenant into a property unless it's suitable for use as a habitation. So on the day you buy it, if you couldn't lawfully put a tenant in there, it's not suitable for use as a dwelling. The Housing Act 1957 is useful, and the Fitness for Human Habitation Act 2018 is even better, because it broadened the conditions under which you couldn't lawfully let a property. And if you can't lawfully let it to a human being, it must, I'd say de facto, be unfit and unsuitable for use as a dwelling. So moving on, mixed use. Most dwellings are residential property, but only if 100%. So the tiniest amount, taking it out of residential, will cause you to come down to 5%. Now, I recognise for inner city properties, commercial activities such as farming, horticulture, woodland or equestrian are likely to be remote. St John's Wood hasn't had a wood on it for about 300 years. But we identified a Victorian 2 up, 2 down for a client where we found out that the current owner was using the basement as a woodwork shop in his trade. And therefore we had commercial activity. Sometimes with the larger blocks, it's because there's a commercial antenna lease on the roof, a telecoms lease. That creates mixed use over the entire building. Useful, very useful. Look at their commercial buildings. Look for any rents or licenses or way-leave income on the site. Substations, pumping stations, antennas. I keep coming back to that one. Pylons, anything you like. All of those create mixed use. Why? Because the way-leave income is classified as property business income. That's in the revenues manuals. Very hard for them to argue there isn't any business on site when they're taxing you on the rents as property business. Duh. Traditional or habitual use of the land. Yeah, what have you question the vendor, what have you used the land for? Looked at a property in Nottingham, traditional 3-bed semi, 1930s brick, red brick. No commercial activity on that. Hang on a minute. That's a really big garage at the back, serviced by an alleyway. They call them Twitchells in Nottingham. I don't know why. Been trying to get that out of my wife for about 10 years. She still can't explain it. But the point was, you go and look at the garage, and you go, right, well, lift the garage door. There's a tiny little corner glass office and a bloody inspection pit. This guy had been running a garage business from the back of his house. That made the property mixed use because its last use included commercial. Little things. So look for trade, however small. We even had a judge in tribunal comment that if the client had been selling the eggs from the chickens he kept by means of an honesty box at the end of the driveway, he would regard that as a trade and therefore he would accept mixed use. You see, occasionally chickens do have a higher value than their eggs. So you have to look to establish the true relationship of the land to the building. That's in HMRC guidance. And finally, of course, as I've said, your rate falls from 17.15 to 5. So one of the things we get asked a lot about, and I'm conscious of the time before the text starts hitting me, we've all seen this business. You've all been incorporating like crazy. And if you've been told, if it's a partnership, transferring to a company, there is no SDLT. And that's perfectly correct, and the revenue accept it. But we see a lot of arguments about what is a partnership. Oh, you can't be a partnership if you work less than 10 hours a week. You can't be a partnership if you're passive. These are all accountants' definitions taken from income tax. They do not apply to Planet Stamp Duty. Stamp duty is a tax in its own right. Provided you can fall within the definition, the relation which subsists between persons carrying on business in common with a view to profit, Section 1 of the Partnership Act 1890, you are a partnership for SDLT purposes. And I've been doing this since 2007 with a revenues agreement every time in things that would otherwise be regarded as a passive investment. But the revenue accept, because of the width of Section 1, that you can do it. So you can have a husband and wife who own even just one property, where ownership has been documented by deed of trust. You may only have one name on the title. And the partnership does not need to have been registered with HMRC, nor does there need to be an existing partnership agreement in place, although if you have been sharing profits, I would always recommend you reduce it to writing, give evidence to it, saying the partnership having started when the flood receded after Noah grounded and having continued since, we now desire to reduce it to writing. By the way, that is a perfectly acceptable form of document in English law. It's not backdating. It's called a retrocessive deed, if you're interested, rather than a retrospective deed. By the way, I'm not a lawyer, but by God, I wish I could stop hanging out with them. And provided you've got that documentation straight and on your incorporation, you write to the revenue and say, because there's no return required, there's no tax due, listen lads, we're not doing a return for the following reasons. You're in the clear. Sometimes the revenue reply, most of the times they don't, mainly because they get so many of these letters they haven't got time to. But it's interesting. I'm going to skip through the common issues. We kind of covered these. The uninhabitable, that's a repayment we got. Permitted development, multiple dwellings. You've bought a building with already existing commercial building. Permission to convert into residential apartments. Usually the owner's done some strip out, usually most of the most valuable copper, lifts, HVAC, all the rest of the kit. That constitutes commencement of development. Therefore, you can claim multiple dwellings relief on that building. And we got client a fairly substantial repayment on that one, if my memory serves me correct. Oh, that's right, yeah, only 106,000. So it's worth looking at, and you can do this retrospectively. Planning permission, Slightly contentious this, the revenue say you can't, we say you can, the law appears to say you can. There are cases going to tribunal at the moment to decide this point. Bare land with the benefit of planning permission, in this case to demolish the existing building, was eligible for multiple dwellings relief. And we got them a refund. Bare land is an interesting one. Greenfield sites, how many here? Does anybody here do greenfield work? Right, so greenfield sites, really interesting. Brownfield infill sites, for example, taking out a series of back gardens and creating an infill. Arguably, you can get multiple dwellings on those as well. Thank you for that. And Schedule 15 and incorporations. And I'm sorry, I'm going to show my frustration. Anybody here a solicitor? Because I really don't. Oh, good, there's no lawyers in the room, great. I get frustrated with this. Schedule 15, we all have known this now for many, many years, and certainly since you all started incorporating because of Clause 24, you have become aware of it. And I still get solicitors saying, I cannot see how there should not be stamp duty on this. And I answer, because it's the law. And he says, yes, I know it's the law, but I cannot see how. What are our other reliefs? We've spoken about these briefly. The property traders relief, buying out of probate, buying in the part exchange new home properties, restoring a broken chain. I've actually used that one myself, my wife did. It was quite successful. And buying where employees are relocating their employment. I guess post-pandemic, where we're all working from anywhere, that's probably going to become less fashionable, but it's nevertheless there on the statute book. Those are all 100% reliefs. So if, for example, you have a property trading company, and I would stress it needs to be a company, and you get a property like this and you think, yeah, nice, we can pick that up, clean it, tidy it, mow the lawns, spend 10, 15,000 on it. There's an upper limit on the amount you can spend on refurbishment, and then we can bang it out and make a quick 100,000. This is the relief for you. But I'll put a tenner on that table now if anybody's ever had their solicitor mention it to them. Oh good, nobody has. Whew, I'm walking out here, at least I'm not walking out here £10 poorer. So some numbers. We have recovered over £15 million in the last 12 months in overpaid SDLT. It wasn't one transaction of 14.9 million and one of 100,000, I hasten to add. You've got to remember these tax rates. You can get from 15 or 17% to 5%, and with a maximum multiple dwellings claim, you can get as low to 1%. Or if you're claiming a probate relief, you can get it down to nil. It really is that variable. I think you were looking at me when I started going, is he real? You can start to see how this thing comes together. How do we charge you? If we advise you pre-completion, it's 25% of what the difference we achieve. If we advise you on a refund, guess what? It's 25%. It's a nice simple pricing plan. I'm a simple guy. I don't like that much complexity in my life. And all you have to do is contact us. It's a free, no obligation review. We don't charge an upfront fee. You can contact us there. You can contact us there. You can contact us there. And you can contact us there. Sorry, where's there? Oh, is there another there? Oops, thanks for listening. If anybody has any questions, I'll be more than pleased to take them at this time. And if you want to speak to me privately afterwards, I'll be hanging around for 10 minutes. Yes, sir?
You talked about the £1 million going from 12, 15, 17% down to 5%. What about on a smaller property?
It would still, well, it would go down from whatever the maximum average rate is to whatever the average rate is below.
So that would go down to less than 5%?
Yeah, I mean, but typically if you're liable to 3% and 2% surcharge and you can get out of that, you're going to be 5% ahead on a property of any value.